Okay, let's answer some questions from the last market outlook, and let me apologize in advance for my squeaky chair. It is May 15th. I'm heading back to Canada for a number of months on June 19th, where I don't have a squeaky chair. Okay, let's begin here. I have a long-term macro concern that I haven't heard much about. With the world birth rate rapidly declining year over year, wouldn't this have a substantial impact on all markets down the road since there will be less consumption? Do you believe this information is already priced in? That's a slow-moving vehicle, right? I mean, that's going to happen so very, very slow that if you sped up history in 100 years, you would see it. But from year to year, the adjustments will be minor because what you have is maybe you have population declining, but you have technology increasing, which lowers the cost of delivering almost anything. So, you could have a situation where companies continue to perform and even earnings increase even as fewer consumers are consuming. But that is more country specific now. While you have the world population declining, that is not true of every country. For instance, while the world population is declining, world migration is increasing. So you have, let's just put North America here, Europe here, you have a lot of migration into Canada. There's Canada, there's the US, and from South America you have a lot of migration in the US. So you can have population at the global level decreasing even faster in some countries, but increasing in other countries. Most of the developed countries, as they embrace immigration, see their populations increase. Other countries that aren't willing to accept immigration will see their populations decrease. China and Japan are two good examples of countries that would not accept the Canadian-style level of immigration or even a US-style level of immigration. So you have to think about it market by market. Couple of questions. A couple is 2. This is 5, so several. This 3 to 5 are several, so several questions. How long do you plan to continue adding content to the applied level? Into the foreseeable future, I have no plans to stop. My plans are to increase. I'm trying to reduce the amount of CFA responsibility I have so that I can continue to increase that. Would this content be available to us for several years? There is no expiration on the applied level. Now, that's not always going to be true. So my thinking is that as a timeline, let's say we're here, at some point in the future, there will be a base price, which right now it's $440. And then every year there'll be some renewal on top of that, except for everyone who bought here. If you bought here, you're grandfathered in forever. You never paid the renewal fee. But at some point, because I continually add, and I'm looking at hiring a couple of people to update 10 queues over time so that each person would be responsible for, let's say, 10 companies that'd be producing 40 presentations a year on particular companies. Every time a 10Q is released, they would have an update going forward. I'm looking at getting that done, but that will require a recurring fee, except for the people who bought before that date. This date is going to coincide with a certain subscriber number, and subscriber counts are increasing faster than I thought they would. So I have to get a little bit more aggressive on building out more infrastructure for this. But once I hit a certain number, I'm not going to tell you what the number is, but once I hit a certain number of subscribers after that, then yeah, it's time to start thinking about what the recurring amount per year would be. But right now it is one price, $440, and there is no expiration. Has there ever been a time when you had a high conviction trade that went poorly? When did you realize it was going wrong? How did you manage it? Nothing comes to mind right now, but I will tell you what went poorly is my ability to stay in the trade, or my willingness to stay in the trade. I remember one time I had a very high conviction trade on Lifetime Fitness, and my plan was to stay in it for forever. But then the financial crisis hit, and this thing went down. I held it too long. I still made money during that downturn, but that one I lost money on. And then I rebought it in the 20s, 25, 26, and I held it for a while, but I still felt it was a winner, but I was nervous and I didn't hold it long enough, and eventually, I think I got out around 40, eventually got bought out by private equity for 70. That really bothered me. So it was high conviction, and I didn't stick with it. That's the only thing that really comes to mind. Well, GM, I guess you could say GM. But GM was, the problem with GM was I had a high conviction in it, and it was so cheap, and I didn't think it could get cheaper, and it just kept getting cheaper and cheaper and cheaper. It broke the $40 mark. It started trading below its book value per share, and it just kept getting cheaper and cheaper. So I did some risk management for as long as I could, and then I took a loss. But that wasn't that was more of a combination of negative sentiment on ICE and positive sentiment on EV that I thought was misplaced. But you can't fight a market, right? How much cash bonds do you hold in your personally managed portfolio? Quite a bit. Last Saturday, Berkshire had its annual meeting, and Buffett said, we're sitting on $200 billion, but because there's nothing to do with it, so we'll take the cash rate. I feel the same way. Of the trades that I have I feel fairly high conviction, I don't want to take medium conviction trades because I'm just not convinced that these are the right multiples where we should be on the market. I'm curve inversion over 2 years on the capital market curve. You're heading up to 2 years. I think in another 60 days, it's 2 years that it's been inverted. Year and a half on the 3 month of the 10-year. That doesn't go on without leaving some scars. So I'm just not convinced. So yeah, I do hold quite a bit. Would there be a time when you sell more puts than what you have in liquid assets? Yeah, if we had a market that was trading at a multiple of 16 or 17, if earnings estimates were starting to increase, if we had a recession behind us where capital was recycled from inefficient firms to efficient firms, I'd be all in. Yeah, I would. I'd be all in. But that's not what we have right now. If you were to find a good opportunity for buying calls, what time horizon and delta do you prefer? That depends on the situation. You tell me why I'm buying the calls, and then I can tell you the time and the situation. Usually if I buy calls, I like to buy longer than I need, but in high interest rate environments, you got negative carry on those calls. On low interest rate environments, the carry isn't that bad. So it is more than costly to buy calls now, because as interest rates start dropping, let's say over the next year, the value of the call will start dropping because of the interest rate dropping. So you have to have the delta perform even harder to overcome the loss on the interest rate and theta, right? If you were assigned T shares, what would be the signal to sell covered calls or to get out? I wouldn't get out. I would not get out. I also like selling puts and holding T at 17. Been curious how to exit when I'd like to liquidate for better opportunities. Then you just sell 17 calls. If you sold a 17 put for 50 cents, your cost is $16.50. If you sell a 17 call for 50 cents, your exit is $17.50. Excuse me. So you could just sell calls. In the applied series, could you add a lesson covering the fine print of a long-only, all-weather portfolio invested in different low correlation asset classes with periodic... Oh, is that all? The part there, invested in different low correlation asset classes, find them. That's the key. Find them. and find them such that they make sense. That's not an easy task. Many investors do not seek alpha, so their best bet is balanced smart exposure to beta. Well, you can do that with you can take SPY 60% and TLT 40%, and if you want to get more aggressive, you can split XLY SPY into XLY XLP 60-40. In consumer discretionary and staples, that's a nice balance in there. And TLT, you can actually go into US Treasuries with a duration of about, let's say 17, and you'll get a better yield. So if you went into Treasuries with a duration of 17 and XLP, so let's say that you had $1,000, you'd have 600 here, you'd have 400 here, and if you use this, you'd have 360 in XLY, 240 in XLP. Nice dividend yield over here, low dividend yield, but great growth, and here, great stability. And then, of course, you have your bonds. There you go. No need to get fancy. Getting fancy has higher fees. No need to get fancy. If you're not looking to outperform, this will give you a nice blended return of whatever the market and whatever bonds give you. Back in December, when the Fed funds futures were pricing in 6 rate cuts, you made the brilliant call to short Fed funds futures. That was the trade. Yep. I think going long Fed funds futures isn't worth the risk right now. Why not? Like if you're looking at Fed funds futures in January pricing in a 5% yield, 4.9 to 5%. How much worse can you get? What's your downside? Right? Like, what's your downside at this point versus what your upside could be? So you may not get a return on it, but I don't see a loss on it. So I don't know where the risk is. The risk is that I get nothing, but it's futures. It costs me nothing to enter. I don't know, and it has no carry. It's not priced to have carry, so there's zero carry, minimal downside because, well, how much, if we're at 5.33 now, and the Fed is talking about their next move being rate cuts, not rate hikes. I mean, you need 1 rate cut, 2 rate cuts, and you're good. You don't lose anything. You get 3 and you start making money. So I don't know where the risk is. It to me seems very low risk with the possibility of upside. Why would you not go long at this point? Why would you go long at this point for just potentially 2 or 3 rate cuts? Because I don't see any downside. Could you do a top-down video on expansion? As soon as we have an expansion, it's hard to do one theoretically. You kind of want to see it, but theoretically it's almost unsatisfying. In addition to X and Instagram, would it be possible to just send applied series updates through email? No, that has a significant cost to it, a big cost, and it's not my site. I mean, I'm just renting space on markmeldrum.com. I don't own it, so I can't direct IT to do that. I have to find my own solution for this. When people subscribe to the applied series, they already have to provide an email address, maybe something IT. Again, it's not free to send out emails. It can be a significant cost, up to $200-300 a month to send emails. Plus, with our subscriber count, most of the packages we've seen for sending emails are close to $600 to $800 a month to send emails. You can't do that unless you have a recurring revenue stream. You can't continually incur a $600 a month charge for a subscriber who paid and then nothing more, because you will eventually spend all of the margin and be in a loss position on each subscriber. So usually when there are email updates, it's usually for a service which has a recurring monthly charge, where keeping engagement is extremely important to lowering churn. So Netflix is a good example, Prime, Apple TV, places like that send you an email every week to tell you what's new, what's exciting, always reminding you why you want to stay. But they have a recurring revenue stream. If you don't have a recurring revenue stream, an email service is just a leak. You're going to need new subscribers just to pay to maintain the existing subscribers. That's Social Security, right? That's what Social Security is, and eventually you run out of money, much like Social Security will. I'm not sure how others feel, but I stay away from X and Instagram, Facebook as much as possible to generate their own unsolicited spam. You can unsubscribe from every email that they send. This is a long one. I've already read this one. The argument this person is making in here is not that Tesla stock is overpriced, but that Tesla cars are overpriced. My conclusion that Tesla cars are well overpriced is my analysis good. It's a detailed analysis, but here's what we're missing. If the car industry were characterized by perfect competition, your analysis is right, the car is overpriced. But it is not perfect competition, it is monopolistic competition. Not monopoly, but monopolistic competition. Monopolistic competition means that you can sell your product. Even though it may be a commodity, you can differentiate it with branding. If you're selling an ounce of gold or a pound of copper, it's the same as somebody else's ounce of gold or pound of copper. So you have perfect perfect competition, and everyone is a price taker. With this industry, it is monopolistic competition where you can be a price maker based on brand. You don't have to have a superior product, you just have to have a superior brand. That's such that the consumer says, I want to be seen in that car. I want that brand. And then you can, layer on all sorts of hope and dreams onto that car, a lifestyle that comes with that car, right? That's the whole idea behind advertising is, what kind of person are you? Are you, one of these man that, you want the big F-150 four-wheel drive off-road package, all of this, because you're a man, right? You can charge more for that. So your analysis would be okay in an industry characterized by perfect competition. We don't have an industry characterized by perfect competition in the automotive industry, so I don't know that I would go to the value of the car and say the car is overpriced. You could say the same thing for Rolex watches. Well, this watch keeps time this way, this watch keeps time that way, and it's a lot cheaper, so the Rolex is overpriced. And you don't buy a Rolex because it keeps time better than any other watch. You buy it because it's a Rolex, right? Regarding ABR, I've been selling 1250 puts for early 2025. They're selling for over $2 because you got the dividend yield, the continuously compounded dividend yield. Correct. Normally selling puts, you want short term because of the high dividend. The longer the put gives you the return. Also, since the next few quarters will be stressed, want a time for them to work through issues without having to put them to me and hopefully interest rate cut. Yeah, okay. Because the large price, put price compared to stock price and margin required ROI could be 100%. One reason I can think of to own the stock rather than long the puts is with the very large short interest you are anticipating a short squeeze. Well, we did have a short squeeze. You are right on that. We did have a short squeeze. I don't know where we are now. I think the short squeeze is pretty much over. Let's have a look. Back under 15, kind of hugging close to the 1480 price, but we did have a short squeeze. And when you have a short squeeze, what's beautiful about the options is they increase dramatically in implied volatility. ABR usually has mid-20s on their implied volatility. They're sitting at 48% right now. I sold the 14s, the 15s, and the $16 calls when it ran up yesterday. 350 calls I've sold with implied volatility in the low 60s. Implied volatility is now in the low 40s. On the 14s, it's 43.6. The 15s and 16s are both around 41. I expect that implied volatility to keep draining out. And while it's draining out, the options are gaining in value quite nicely, by the way, too. I'll do quite well on that. But yeah, short squeezes are beautiful. Is TLT more sensitive to changes in long-term interest rates and short-term? Yes, it is. If so, what will happen to a long position in TLT if the yield curve steepens again? The price will go down. I share your view the market is overvalued, but given the scenario, market pulls back 10 to 20%, which is something I would like in order to enter into a long-term position. Same here. Which allocation would you choose? SPY, XLY, or QQQ? To be more precise, do you think XLY and QQQ could outperform SPY in 10 years? Yep. Or should I just stick with the broad market index like SPY? No, I think tech will outperform over the next 10 years easily. Corporate buybacks mainly benefit the rich who own half all the stocks. Jesus Christ. CEOs use it to manipulate their stock price to maximize their compensation. Companies like BA and NSC have done massive buybacks over the years while underinvesting in their respective businesses will literally cause deaths. Corporate buybacks do not mainly benefit the rich. CPP, almost any government pension plan, Social Security, they own, I don't know what percentage of equities they own, but they own equities, and buybacks produce gains for millions of people, not just successful people. And who cares if successful people enjoy some rewards for all the work they did in becoming successful? Come on, man. Mainly benefit the rich. There are no rich people in the world. Well, I shouldn't say that. In developed economies, of the people who you call rich, very few of them are rich, okay? The vast majority of them are successful. And you know what happens when you're successful? You generate more income than you spend. So if you keep it, you build wealth. Wealth is not what you make, it's about what you keep. Everybody, I shouldn't say everybody, but let's say 90% of these people you call rich earned it, okay? They earned it. So enough with this, it benefits the rich business. If you work hard, if you do the right things, if you're willing to sacrifice, and you build something, you're successful, okay? You deserve the rewards of that success. What you don't want is somebody saying things like, oh, the rich just get richer. Come on, man. Come on. Enough of this. How do you come up with your desired option price? Currently, if I would sell TLT at 89 in June, my initial margin would be 766. My maintenance margin 7, 130 expected premium. I expect you in for 17%. No, the 130 was, I looked at the bid and the ask, and I saw TLT weak that day, and I thought, well, let me anticipate. It probably has a little bit more weakness in it. I'd like to get some puts. I'm going to project out what I think based on the delta, and I think TLT drops another 30 cents maybe. It has support down here. The delta is this. That would put it at 130. Let me go there. And it didn't get there. But that's what the 130 was for. 10K is very solid for views for this kind of content. Yeah, I see other channels that I think are pretty good, doing so much better. So it's sort of demotivating after a while when you look at it and you say, I just can't crack that 10,000. I don't understand why. I don't understand the hate against buybacks. I know. It's a valid strategy to optimize the cost of capital between equity versus debt. I agree. When equity is cheap, buy it. And issue it when you need capital when it is better than debt. I agree. Taxing buybacks seems as silly as taxing unrealized gains. I think if you tax buybacks, what a company should get is a rebate when they issue shares. Maybe they should get a subsidy when they issue shares. If you're going to tax the buyback, saying, oh, you're going to reduce your share count, you're going to pay a tax. Well, then if I increase my share count, can I get a subsidy? Which would be the opposite of the tax. Can I get a subsidy? But I don't think the people who set the taxes think. Curious if you could speak to the price action this week on ABR. Yes, it was quite interesting, but it was just a general short squeeze. It started with the whole GameStop, return of Roaring Kitty again, and all the stocks that had short interest. Everybody remembers what happened last time, and funds got scared, and anything that they were short that had a huge short interest, let's just cover. They got scared, and I don't blame them. So it was just a fear of what we saw 3 years ago happening again, and nobody wanted to be part of that. So best to get out. I expect ABR to retrace back to the low 13s. Its book value per share is in the low 13s. Its balance sheet is primarily financial assets, which means financial assets will trade at what you can buy them for. There is no premium in financial assets. You holding a 10-year bond and me holding a 10-year bond doesn't make your 10-year bond more valuable because you hold it, because you're somehow better at holding it than I am. It is just a 10-year bond. If you attempt to ask anything more than the market price, I can go somewhere else. That's financial assets. So usually things like mortgage REITs will trade very close to their book value per share. In tough environments, they'll trade at a discount. In environments that are getting better or that are hope to get better, they'll trade at a slight premium. But very rare will they trade at significant premiums. ABR is at a significant premium right now. So I expect it to retrace back to the low 13s. Any tips on growing a subscription-based business like you did with your CFA prep content? What did you do to set yourself apart? Well, there are three things that you have to think about when you're growing a business. And it could be any business. It doesn't just have to be subscription-based, but you have to think about your pricing. You have to think about your product. Right? And then you have to think about your promotion. So if you're going to spend money on promotion, that's going to push up your pricing even before you get a single customer. I find that a lot of businesses spend a lot of time here and a lot of time here and deliver an average product, but spend a lot of time on their pricing and their promotion. So MailChimp is a good example. If you go to MailChimp's website, you'll see a free option. That you can try it out. You click on the free option, you answer a few questions, the free option disappears, and there's a paid option. You never get the free option. You never get it. It's just designed to get you to click. And then you'll try all you can to get back to the free, and you'll never get back to it. A couple hours later, you say, okay, well, I guess I'll take this one. So you click, okay, buy now, and you'll go to another screen where the price increases. And then you say, well, I thought this was $20 a month. There was one fee. It was like $250 for the year, and then it's $20 a month. And you find out, no, it's $250 per month, and there is no $20 a month after 1 year. Try and try and try as you can. You can't get back here. So they have a team that devised that their goal is after 2 or 3 hours, you think, how much money do I have in this trying to get the free product? I got to pay people to set this up. I'm out $150 in labor so far. Let's just take it. It's designed to wear you down because their product is just an email service like anybody else. So you can go to other sites and get a free trial on something and get significantly lower prices than MailChimp. But MailChimp spends a lot of money on promoting and then a lot of money on their pricing strategy that is misleading, that's bait and switch, designed to wear you down so that you just buy it after you invest that much time. And the product is meh. I would encourage you not to do that. I'd encourage you to spend all of your time here. All your energy here. Your promotion will be word of mouth. It'll happen on its own. And then set a pricing strategy that is transparent and live by it, period. So if you want $100 a month, say it's $100 a month. If there's a free option, say there's a free option, and make it easy. That when they click on free, it's easy. It's just easy. That it doesn't disappear and get switched with something else, right? Be honest, be transparent, make the best product or service you can. Word of mouth will carry it from there. You should not be paying anything for promotion, because if you do, you have to increase your price, which means those who are buying your product are paying for the product and promotion at the same time. And you don't want to do that. You want them just to pay for the product. You know, if it's good, you'll get promotion, and set your pricing to be transparent and honest. There's nothing wrong with charging a premium price if you got a premium product, but be honest about it. None of this bait and switch stuff. Don't be a MailChimp. If we purchased a long call option, let's say XLE 100, but the stock drops and we aim to decrease the cost by selling a short-term call, transforming it into a diagonal spread, how can we evaluate the potential risks and P&L for this new combination, considering the call prices have already declined? If you got a long-term call of 100, I don't know why you run the risk of you know, if you're selling the short-term call, what you're hoping is that it stays below the short-term call price. Instead of the long-term call price, you bought the call so that you have limited downside. You already have limited downside. You know, if you believe that the price will stay under the lower price, you can sell that one. As far as evaluating the potential risks and P&L, just think about three scenarios. The price stays under the strike. This price goes over the strike, right? And you just have to have two different scenarios to figure it out. I don't know that I'd want to calculate a whole nonlinear payoff as a function of time. Yeah, I just see that as a lot of technical work for what? What incremental value are you hoping to get out of it? Like, what number would tell you, oh, I don't want to do this, right? I mean, you're thinking of offsetting some of the loss you have. Is there some analysis that you would do of which the output you would say, oh God, I'm not doing that? If there isn't, and it's just, well, I want to know, anything that you try to figure out will be built on a mountain of assumptions. Just a mountain of assumptions, because the future is unknowable. So you're just making a big amount of assumptions. I think the easiest thing to do is look at your net delta and just ask yourself, well, what if it did go back up? Would I be comfortable with this? You'd have a short position and a long position, right? You'd have a short position in XLU and a long position in the call. How would you then deal with that? Yeah. It's hard to answer these theoretical questions, because it's like, well, how long is long? How short is short? How far under the strike price is it? What price are you thinking of selling? Like, there's so many variables that there is no one answer to this. It's, you show me what you got and what you want to do, and then I'll tell you what I think. I think you should keep going on the political side of things, especially as it relates to finance, spending, inflation, the effect on the broader economy. I don't see too many informed opinions. Did you mean the December 50 puts for CAR? There is no 50 strike for the October. Well, I got the options chain in front of me. Let's see what I was looking at. October. What was I looking at? November? December? Should be around 4 something. 495. Yeah, the Decembers. What do I have Octobers of? Oh, I got the October 13 puts on ABR. I probably got confused between the CAR and the ABR. All right. On why Canada does not have a 30-year fixed rate. I like this comment. I did read this one. We have the Federal Interest Rate Act that limits prepayment penalties on mortgages with longer terms than 5 years. So because lenders cannot be compensated for the prepayments on these longer term mortgages, there are very few lenders that offer them. That makes sense. Also, the bond funding markets would need to be adjusted. Canada doesn't have as deep of a 10-year plus bond market compared to the U.S., so more difficult for lenders to hedge fund themselves. Okay. Do you think the 30-year fixed mortgages are a net positive for the economy? Well, they have been for the U.S. consumer. If we look at, if you rank all of the countries in terms of the types of mortgages they have, you'll see that the ones that have the more floating rate mortgages, and I think I have a chart of this I'll be using this Sunday in the Market Outlook. If you look at the number of short-term fixed rate mortgages, like 5-year fixed on a 25 or floating rate, those with the most sensitivity to changes in rates are the countries where the central banks are already thinking of cutting or will be cutting. So because of that, everyone will benefit from lower rates. But if you have a 30-year fixed in the U.S., you're doing okay. Given that households have fewer options and lenders to hedge interest rate risk, I think households would benefit. Yep. Although it could come at the cost of less mobility and less supply coming onto the market. Yeah, every advantage has a disadvantage. Currently working for a large financial institution as a broker processing trades, servicing brokerage accounts, considering leaving and starting a consulting business doing one-on-one coaching for anyone new to managing their own brokerage account without an advisor. Also considering starting a YouTube channel, making short educational videos to help advertise my services. Though I would only provide operational education, wouldn't provide investment recommendations. There's so much regulation in the industry that I'm still afraid the SEC will send SEAL Team 6 after me for something. Just wanted to ask you a couple of questions. Well, the SEC, not the SEC, if you're in Canada, oh, you're in the US. If you're in Canada, it's the OSC, at least in Ontario. And yeah, they are hair trigger sensitive. If you are seen as giving advice and charging for that advice, like one-on-one coaching, you give any advice in there, then you're an advisor. You better be registered, right? Am I being too paranoid about regulators? No, you are not. This industry is competitive. And if you are doing anything that looks funny and a competitor doesn't like what you're doing because you're taking business away from them, you will have to answer some questions to somebody somewhere. The worst is the people you advise. Let's say that you're coaching somebody and they follow your lead, and things you say, and they start losing money. And it's not your fault, it's the market's fault. It doesn't matter. They looked at you as an expert, which means you had a duty of care. Even if it was clear that all you were doing was giving education, you had a duty of care. So I would avoid the one-on-one. I don't do any one-on-one. I won't do any one-on-one. I just don't see the value in it. And the other thing is, for the one-on-one, nobody will pay you until they recognize that they can't do it. Nobody will pay for a solution to a problem they don't have. If they're going to manage their own money, it's because the problem they have is the professionals don't know what they're doing, right? And then they'll try for a while and lose money. And then they'll start to look around for answers. So it's... the answers they're looking for are "please save me," which is a very difficult thing to do. That's a snake's nest you're getting involved in there. It's just a snake's nest. I myself would not do one-on-one coaching. I just wouldn't do it. It's not very scalable. Do you have to be careful what you say on your videos due to regulations? No, because I manage nobody's money and I advise nobody individually. I meet with nobody and discuss their investments. I offer no advice. I do nothing like that. So because I'm not generating any fee revenue, I'm not putting myself out there as an advisor. I'm not doing any of that stuff. It doesn't affect me. Now, let's say that bought a whole bunch of a nothing stock, 50-cent stock. And then with the audience I build up, I start promoting this. I mean, really heavy, without telling you that I put my money into this. And the price starts going up and up and up, and then I start selling it without telling anyone. That's a pump and dump. If you can prove that I've done that, that's illegal. There I got a problem, right? But for the most part, for what I do, not really, no. If you ever any copyright issues when you're using web servers like Koifin? Nope. Nope. Anything that is publicly facing, you're good on. Anything that's publicly facing. What has been your experience with monetization on YouTube? You're not going to get rich. You need 1,000 people before you can monetize. And the amount you make per 1,000 views is based on engagement. The more engaged your users are, the more you have the right target market, the more money that you can make per 1,000 views. The more subscribers you have, the more valuable you are. So it's not as if you're going to make $6 for every 1,000 views, like some of the channels that have 2-3 million subscribers. You might make $1.50 per 1,000 views. You might. So it's not. It's certainly not. I mean, if you have 20,000 subscribers and you're doing 4,000, 5,000 views a week on your videos over the course of a month, you might pay your cell phone bill, right? That's about it. The big dollars are for the big producers, the content producers that have 2 million, 3 million followers that are putting out 3-4 good solid videos per week with good engagement, where you have 60-70% of the subscribers watching that video and watching it all the way through. Then you could be as high as $6 or $7 per 1,000, but it's a long climb in a crowded market, in a crowded space like finance. It's a long climb. And of course, any additional advice on starting a business and or operating a YouTube channel? Deliver value, period. Don't worry about what you can get out of it. Think about what you can put into it and deliver value. If you have value, if you're doing something of value, people will find you. One aspect I am somewhat unclear about is sizing. You have some choice of enumerations regarding investing ideas, which you have recently spoken about, with highest conviction being cap rate. How do you determine sizing between these? I don't know. I don't really have a particular formula really that I follow. I try not to make the position too big. If it's overwhelmingly a great deal, I'll go really big, and then when it becomes an all right deal, I'll lighten up. So cap rate I was buying at 43 in the 42s, hoping to see 41 and 40, never did. So maybe when it gets to 40, like I have a fairly large position, maybe when it gets to 49 or 50, I might close some of the puts that I had. If it gets to 51, 52, I might say, well, let's take 20% of the position off. As it becomes more fairly valued, then I want a normal size. I don't want to be oversized. I wouldn't continue to hold 28,100 shares in one Canadian apartment REIT. As the price started to approach its net asset value, I'd say, okay, well, let's make it a more realistic holding if I wanted to continue to hold it. So it's more just experience over time. You get to sort of feel where you're comfortable with a certain stock. Thoughts on buy and hold? No, none of those 3x leverage things. I wouldn't touch them. No, very simple. Could a call ratio back spread be a play on Nvidia? Depends on what you believe, right? There is no one play. You tell me what you believe, and I'll tell you if it makes sense, right? If you think, oh, this thing is just going to sell off badly, well, that would be a different strategy. If you think it's going to do very well, that would be a different strategy. So there is no one play. Is selling puts on stock ABC a good idea? I don't know. You tell me what you think will happen to ABC, and I'll tell you if it's a good idea given what you believe. Since we don't know what's going to happen, everything is based on what you believe. Did you say you were selling 12 puts on GT? Trying to, but I think it's really taken off. Where are we on GT here? Let me just look over here. 1291, 1292. I see it pushed down to 12. I'll sell $12 puts. Yeah. If so, did you get them filled? No. I'm assuming it's due to long-term global demand for EVs and their weight resulting in tires shorter life. The more cars that are made, the more tires you need. The heavier the car, the faster the tire wears out. If you have a lot of EVs, EVs go through tires twice as fast as ice, double the amount of tires that are being sold. Right? It's a simple calculation. And are more EVs going to be sold? Yeah. If you look at National Highway Transportation Safety Association, you look at EPA, they both govern mileage, fleet mileage, and emissions. And to meet the aggressive standards from 2027 to 2032, all car companies are going to have to move into plug-in hybrids or electric. They're going to have to, otherwise pay a big fine. So you can have a car company, and this is important to understand. You have a company that is producing electric vehicles, and let's say that it's not making any money on the electric vehicle. It's completely broke, or it's losing, let's say, $10,000 per vehicle when it sells it. The fines that you would pay on the other side for not meeting your standards are so large that breaking even or even losing $10,000 would be a better situation than paying the fine. So they're going to be coming on the market no matter what. So as far as people who really like the fact that Tesla sells EVs, no one else does, no one else is making money at them, they don't have to make money at them. They just have to lose less on it than they would with the fine, but they are coming. They are coming. Simple as that. So there's going to be more electric vehicles over the next 10 years, period. Double the amount of tires. Double the amount of tires. Unless you can reduce the battery weight, double the amount of tires. So yeah, I'd like to build a position in that company, but it's not ready to go yet. So I don't want a fair price. I want to steal it. I want a low price. So I'm willing to wait. Are you worried about GT's debt? I'm not worried about any debt that management recognizes as a problem. The moment management says we need to address our debt, then I know at least it's while it's a problem, it's not going to be a problem. The biggest problem is if there's excessive debt and management doesn't recognize that it's a problem, then it's only going to get worse. That's where developed market governments are right now. What did I hear on Yellen say the other day? Is that the U.S., and of course she has to speak for Biden, she has to give Biden a lot of cover, is that the U.S. can handle a much higher debt to GDP level than it currently has right now, and we're going to be just fine. So what you have is an administration that does not even recognize that there's a problem. And if you don't recognize there's a problem, you don't do anything to solve it. If you don't think you have an eating problem, you don't cut back on your eating. If you don't think you have a drinking problem, you don't cut back on your drinking. So I don't care if there's excessive debt, as long as management recognizes that they have debt. AT&T has huge debt, but management each quarter says, we are focused on the debt. They recognize they have a problem there, or that it can be, it is a number that's big enough to warrant attention. So that's all I care about. General principles on when you sell options. How do you arrive at the premium you want to collect? don't know that I have any general principles. When I sell options, it's on something that I want to own anyways, and it's at a price that I would buy it at anyways. But that, for one reason or another, I'd rather just sell the options. Not really, maybe I don't really care to own it, but if I did own it, that would be the price I would own it at. If I really want something, I'll sell in the money puts if I'm trying to get a lower price than what the market has, to guarantee that they'll be put to me and maybe I'll get an extra 30 or 40 cents better than where the market price is. But I don't have general principles. If the premium's too low, like if I'm selling options and let's say you're getting $300, but it requires a $20,000 margin, it's like, okay, I'm not going to do that. That doesn't make a lot of sense, right? If it's too low, that doesn't really make a lot of sense. I find something that gives you 1.5 or 2% annualized return on the amount of capital that you have to put aside too low. Unless you're doing it for hedging purposes, it's too low. 6% is nice, 6-7% on an annualized, not on an annualized basis, but on a term basis. I shouldn't have said an annualized basis. So let's say you're looking at 30-day options, and the premium as a percent of the margin is like 1.5%. That doesn't excite me. Once you start getting to 5-6%, okay, that's interesting. 10% is nice. If you can get 10%, that is nice. But 10% comes with risks unless the market made a mistake on pricing. Which with ABR, the market made a mistake on pricing. So I went aggressive. And I got, I don't know what the returns are. They were like in the 20%. It was nice. After going through the automotive sector studies, have you gained any insights or extra knowledge that would have changed your mind on having a significant long position GM? No. I did do a lot of analysis on the auto industry 2 years ago because I put out 2 very long videos. The first one called The Ice Age is Far From Over. That was at a time when I was firmly convinced that my next vehicle was going to be an EV. That my truck was at that time 9 years old, and I said, well, I don't want to buy another internal combustion engine because in 8 or 9 years I won't be able to sell it. I want an EV. And then I did that video, and then I realized that I don't want an EV. Dear God, I don't want one of these things right now. I want a plug-in hybrid, but I don't want an EV. But there were no plug-in hybrids, so that's why I concluded the Ice Age will be with us for a long time. So no, nothing I've done now at this point changes my mind about anything. What it has done is it firmly convinced me that Tesla is a short. Not just thinking, not just looking at the multiple saying, well, the multiple's ridiculous, it's a short. It is inherently a short because it's a lie. What you're being told from the company about the timelines and what's going to be delivered cannot happen. It is almost a technical infeasibility. It cannot happen, and there are so many things that have to happen first before this robo-taxi future happens. It simply isn't going to happen. It's a lie. So what it's shown me is that I'm even more convinced that Tesla is a short, and I'm even more convinced that GM is better than Ford. That's what it got me to. For CapREIT and other REITs you mentioned, do their respective MD&As have commentary on how they calculate NAV and whether NAV is adjusted for an expected decrease in interest rates? Well, these are IFRS reporting companies, right? So they are reporting their investment property at fair market value each quarter. So they're based on where interest rates are and where NOI is, they report their NAV. Now they do report sensitivity in terms of what their net operating income would be based on interest rate, based on changes in rates. I didn't look to see whether or not they calculated NAV based on changes, because changes in interest rates change the cap rate. It also changes the present value of the net operating income. But lower rates also give apartment REITs competition with housing. So, other than doing some sensitivity analysis, it's hard to pull that apart. But we get it quarterly, so how often will interest rates change in one quarter? Maybe 25 basis points, right? So then you'll have an empirical change in NAV, so you can look at it that way. In other words, when looking at the stock price versus NAV, it looks like the REITs are a good buy. But what if the difference is largely attributed to the difference of opinion between the market and REIT management on the magnitude timing of interest rate cuts? I don't think that's what's holding back the Canadian apartment REITs. I don't think that's what's holding them back. I think what's holding them back is the belief that the big rent increases are done, that net operating income growth cannot possibly continue at this rate. And I think that's sort of where they are. That NOI is probably going to go sideways for a while, and if it goes sideways, the net asset value will come down to the market price. I don't believe that, based on the trend in the population and the level of immigration and the slow rate of home construction. People got to live somewhere. That instead of 2 people living in a 1-bedroom apartment, you'll have 5 people living in a 1-bedroom apartment, but live in that apartment they will, right? There is recent data out of Toronto that shows that of the condominium buildings that are being built right now, the small footprint condos, the 600 square foot or less, that 75% of them are investments, are second units for people who already own something somewhere else. They're all investments for rental. That's how hot the rental market is, and these pre-bills won't be on the market for another year, another 2 years, right? So there's nothing significant coming on the market anytime soon, and there's no significant slowdown in permanent immigration coming into the country. This can continue for a couple of years. Once you build your position, AT&T, will you start looking to sell strangles? Probably, yeah. Congrats on finally not having the right call. Not only having the right call, but at the right time. Tesla. Where are we today on Tesla? This morning it started running up past 180. We're back down to 174. Yeah, that's nice. 174. Empirical duration on corporate bonds is lower than treasuries because spread change counteracts change in rates. Yeah. This is generally because rates are cut in recessions where POD is increased. Right, meaning credit spreads increase. Correct. They have a negative correlation. In our current situation, could we get higher yield corporates and still make a duration play if we don't believe spreads will increase? Well, that's exactly it. If you think spreads are tight, right now spreads are tight, okay? If you start getting rate cuts, and if you want corporates to outperform treasuries in rate cuts, you have to expect as you get rate cuts that spreads would tighten even more. Because if all you're going to get is the rate cut, you can get that out of a treasury. So you would have to believe that spreads tighten even more. For that, I'd be looking at MBS. If I'm looking at outperforming treasuries on a rate cutting environment, I'd be looking at MBS because the spreads are not tight. They're really wide. I'd be going into MBS. Staples and utilities outperforming due to rates, rotation in the cycle, the defensive sectors is just noise. Utilities are outperforming, I think, for 2 reasons. Number one is potential rate cuts. Utilities will always do better, but number 2 is the I think the growing, not just belief, but the acceptance that the amount of assets that utilities have are going to increase significantly over the next 5, 6, 7 years. as you move more and more and more to a digital world, as you move more and more of your transportation energy from carbon to electrons, the grid is going to have to expand. And utilities have a set rate of return. So when we determine the price that utilities charge, the regulators start from net income and work upwards to figure out how much revenue the company needs, and that's the rates. And the profit that the company makes is a function of the amount of assets they have. So if we want to know the future of utilities, we want to know at what rate are their assets going to grow, and their assets are going to grow significantly. So given a guaranteed income, that income will increase at the rate that assets increase, and it's estimated that assets are going to increase anywhere between 6 and 8% for the foreseeable future. So you have a dividend that's going to increase at 6 to 8% per year. That makes utilities a rising perpetuity, an increasing or a growing perpetuity, which is a great bond to buy, a growing perpetuity. Which is basically what you're buying when you're buying a utility company. So I think utilities continue to perform well. If you have the applied level, if you watch the video for understanding electric utilities, you'll understand everything I've just said. And you will come to the same conclusion that with the rate base, which is the amount of assets that it can generate a return on, a guaranteed return on, with the rate base set to grow, earnings are set to grow, period. Period. You're either a genius or you must have some serious market movers watching your video. I don't think there's serious market movers watching my video. So given your tree diagram here, genius or serious market movers, I'm going to have to go with genius. I've seen CAR, ABR, FCX, Newmont, GM Performance. You speak positive of them. I can't take credit for ABR. I liked ABR on its own fundamentals. What happened to ABR this week was luck. And sometimes it's better to have luck on your side, right? What happened was luck. It was a short squeeze and up it went. Here's what I did. You're going to find this shocking. I sold all my ABR. Somebody had asked me, what would it take for you to sell ABR? And I thought, I don't know. I don't think I would. But I did. I sold all my ABR. And then I sold calls. So I'm actually short ABR, right? When it drops back down, and I think it'll find its way back to the low 13s, I will then cover my short calls, and I will rebuy ABR. So in essence, I have broken up with ABR, and now I'm dating ABR's sister. I'm short. And then once I'm done, I'll go back to ABR. And much like Ross and Rachel, I will just say we were on a break. But it went up too far, too fast, way above its net asset value, and financial companies with financial assets rarely ever trade there and rarely ever hold it. So yes, as of right now, it's a short, but a short down closer to its net asset, its book value per share, and then I'll rebuy it. But I can't take credit for ABR. But the other ones, this comes just from research. Just from like Newmont, I wouldn't have picked up on unless I went through the understanding gold mining video, because you got to do the industry analysis, you have to do a company analysis, and then figure out where you want to go from there. And only after doing that and seeing their plans and what they want to do did I think, okay, well, I don't know how much upside there is to Newmont, but at $37.50, I'd want to own this based on what they have and where they're going. And so far, so good. Newmont is sitting still well over, where are we today? $43, over 43. I've also sold the $40 puts for, let me just slide over here, Newmont. $40 puts for June. I got the $40 puts. What are your thoughts on the strength of Chinese equities in the last few months? Yeah, they have been doing quite well. And the latest out of China is that the government is thinking of buying all the empty properties. So if there's empty properties that can't be sold, the government is thinking of buying them. they'll end up being the biggest landlord in China. Well, I mean, weren't they always the biggest landlord? Have you ever actually done the rolling 6-to-8 buying call strategy on SPY? You really only do that if you have a confirmed bull market, and I would only really do that coming out of a recession in a recovery. When you start to see everything start to get better and earnings estimates are low but starting to increase, then I would do that. But at these levels, at these multiples, I'm not interested. I'm not interested. Has Vodafone crossed your path? Yes, it has. Price battered, price to book 0.36, dividend 11%, could be a good alternative for selling puts. Yeah, I was looking at the $8. They're British. You say, well, I guess you could say they're major European telecom. Well, I guess you could say that. They do operate on the continent. They just got permission or clearance to sell $4.5 billion worth of assets. So they do have a plan to fix their broken company. Mid nines right now. Let's call it fairly valued. I don't like fairly valued. I like undervalued. So if you owned it when it was under $8, I think you're doing quite well right now. But if I see it pushed back down to the $8 mark, I would gladly sell $8 puts, and that's on the ADR, right? So the price of the British pound has been increasing in value. So the change in the currency can change the value of the ADR without Vodafone changing. So when you're playing the ADR in the US, you are inherently making a bet on the British pound and the company at the same time. So if you see it increase, all you need is a decreasing US dollar, and the price of that'll go up. You have two bets in there, right? You have the company bet and you have the dollar bet. Now, I don't know where in the world you are, so I maybe should premise that with if you're in the UK and you can sell puts on it, then you're probably then you are just making a company bet. But if you're using the US ADRs, you're making a company bet and a currency bet. Wants to know how to generate interest on funds deposited in Interactive Brokers. They just pay you. You just leave it there. The 5% something they mention in their ads. Can you please guide? You just get paid. You don't actually have to buy anything. You'll get paid. You'll get the money market rate less 125 basis points. So if you have US dollars, I think they're paying 4% on US dollars, paying 3.75, 3.5 on Canadian. But you just get paid. You don't actually have to buy anything. You can always do better by buying money market securities, though. So in Canada on IB, I believe you can buy marketable CDs, and they pay, I think, about 50 basis points better than what Interactive Brokers pays. Specific reason you want puts TLT at 1.3, already talked about that. How long does it take for the PPI numbers to feed through to CPI? Sometimes they never do. So you would just have margins that are compressing. If you're talking about the stages, stage 4 to stage 3 to stage 2 to stage 1, sometimes they never feed through. And not only that, when you're talking about those stages, sometimes there are hedges in place that this is not accounted for. If you're looking at final demand, that's usually fairly consistent with where CPI is. It's not that it feeds through, it's just looking at prices from a different perspective, right? How long they take to feed through depends on what it is you're looking at. Sometimes the prices, the price your supplier pays is pretty much the price you're gonna, if that price goes up, your price goes up, and sometimes it's immediate depending on what it is they're delivering. Sometimes it's longer, but it's not always true that a rise in my input costs means a rise in my selling price if I feel that I'm in a competitive environment in which I cannot raise prices. Then my margins just get hit. So that is probably the auto industry right now. Can you expand on cost basis of stock and selling options against it? Let's say I sell puts against a stock I own shares in. If you sell puts, can I reduce my cost base of the stock? No, you can't. Not if you sell puts against a stock that you own, because puts would be, if they're put to you, you'd incrementally increase your position. If you sell calls against stock you own, the calls that you sell, rather than being a mix of capital gain and income, you could, in your worksheet, and you do have to produce these worksheets if you're going to do this, you could say that it was that you sold calls for exactly the number of shares you had, so you can reduce your cost basis. But it's if you plan to sell those shares within the same year, anything you've done within the same year doesn't really matter. It's a lot of work. It's just a lot of work. So there has to be scale. Like if you have a small account, let's say $20,000 account, and you've done a few of these, and you got $400 or $500 that you could reduce your cost basis by because you sold calls. It's just not worth the time to do all those extra worksheets. It's just not worth it. You'd have to be doing it at scale. Are those SPY puts expiring August 1st? I don't have SPY puts. I have ES, short ES. In these days of peak Fed funds and low volatility, finding that I can almost fully finance leap calls with the yield from the 1 or 2 year treasuries. Well, that's the point, right? So if you have a 1 year call option, it will be priced out with 1 year SOFR. Because 1 year SOFR is a secured rate, it should be very close to the 1 year treasury rate, 1 year T-bill rate. Yeah, it should. If you're long the T-bill and you're long the call, you should have no carry. You're not going to make any money on your T-bill, because what you make on the T-bill is what you lose on the carry on the call. That's the point. It's you've just figured out what the cost of carry is. It's the cost of money for the year. By doing so, I can acquire market exposure for the small price of a risk-free rate. Yeah. Are these DIY structured products indeed an efficient means to finance your long-term deltas? Well, you got to think about it. You're putting away that much money just to reduce your carry. Can you outperform the risk-free rate by putting the money somewhere else? So let's say you bought a 1 year high yield bond. Well, you can get 9% or 10%. You don't have to just get the treasury yield. You can buy another security that has a higher yield. You can buy a stock like agency, which has a 12% dividend yield. That more than covers the carry that you'll pay. So all you've uncovered is that the option is priced out with the same interest rate that for the same period of time on a treasury. And that's exactly how they're priced out. If BOC cuts interest rates in June and then cuts for a total of 75 to 100, does the interest rate differential between US and CAD hurt the Canadian consumer even harder? Well, it hurts the Canadian dollar by making it weaker. I don't know if it hurts the Canadian consumer, as CAD will be importing inflation from our... Well, we don't know if we're importing inflation. You can import deflation. If your currency is weakening, you can't say that you're importing somebody else's inflation. The weakening currency could be creating domestic inflation, but it doesn't mean that you're importing it, which can also lead to a wage price spiral. I don't really think so. we have a trade balance that is negative to positive, which is rather small for the amount of stuff we sell to them and the amount of stuff we buy. Even with a trade deficit, it's small compared to our GDP. Does the BOC always need to maintain a certain interest rate differential with the U.S.? Nope. No, they do not. Probable trajectory and end game for U.S. government not recognizing spending problem. That at some point it will be the only problem. So if you don't recognize something as a problem, it will eventually become your only problem. You're going to have to deal with it at some point. And usually when you do recognize that as your only problem, your options become limited, that you don't have the range of options you had before. And given governments today, if you get to that point, I can guarantee you which option they're going to use. They're going to use confiscation. So they're going to say, well, we need new taxes, and we have to go back and tax the same people. The rich, you just need to pay a little bit more each time, a little bit more. Death by 1,000 little bit mores. You risk chasing capital away, which, by the way, is already happening in Canada. It's happening in Norway. For those of you who think that, oh, people will keep working, that we'll all be horses on this animal farm is ridiculous thinking. Capital is already leaving high tax areas. Look at California. And that money's going to Texas and Florida. Look at New York. Money is leaving. If it can leave, it will leave. How much of a spread between Fed and BOC rate will there be? I don't know. It's usually said a 1% spread between the rates are acceptable. But do you think they can widen to 1.5 to 2? The reason the spread seems to be rather consistent is that Canada hugs very closely to the U.S. in terms of economic performance. Usually. Now, if the U.S. turns down, Canada turns down. It's just that simple. We cannot have a growing, expanding economy with the U.S. in recession. It doesn't work that way. We can be in recession while they grow, but we can't grow while they're in recession. So usually, because we have such high linkages in trade, we usually kind of move in lockstep. However, we do have very different policies in terms of taxation and in terms of immigration, so that we could enter into a recession while the U.S. continues to expand, and that interest rate differential could expand quite significantly, could get to 2%, sure. But you'd have a 50-cent dollar at that point. I find it deeply, I hope to follow in your footsteps. Okay. What advice would you give on investing in the European stock market? I know nothing about the European stock market. I know nothing about it. What happens to open options when a company files for bankruptcy? Then either they go to zero, the deltas go to 0 or 1. And if the deltas go to 1, then every option is worth its intrinsic value for deltas with 1. If it goes to 0, every option is worth 0. Why do you think the 30-year mortgage over 10-year spread is so much higher than historical average? That's a good question. I don't know. For a while, it seemed stable around 200. Now it's been 250 to 300. I think it's the market thinking that, well, the Fed is letting MBS run off and they actually want to sell it, so it's already putting a spread in based on what they're going to sell for. But they won't be selling for at least a year to 2 years out. They're going to let it run off for as long as they can. I don't see selling for 2 more years, 3 years at least, 2 to 3 years. So I think it is mispriced. Countries with very high debt to GDPs eventually experience a major devaluation in their currency. Well, I don't know if I call it a major devaluation in the currency. It's not as if we all wake up one day and say, whoa, we need a major devaluation. Usually it devalues over a period of time. What is the end game for Japan? I don't know. A worthless yen? I don't know about a worthless yen because you have taxing authority and printing authority. If you have taxing authority, you could just say, look, it's 90% estate tax. You know, we get to keep everything. You could do that. Keep in mind that every single penny a government spends has to come from you, period. So the thinking from a government is, look, we spent all this money, and all this money was your money that we spent, so everything you own belongs to us now. Because, I mean, who else is going to pay for it? Who else is going to pay for it? This is the country's credit card bill. You're the one sitting at the kitchen table. It's got to come from you. How much you got? You know, I got nothing. Well, how much you got? All I got is a house. Well, that's ours now. In the end, that's all you can do is confiscate property by calling it a tax. And so as long as you have taxing authority, you can get it done. Fabier, if it gets stuck in a channel, why not selling puts inside of longing? For ABR, if it gets stuck in a channel, why not selling puts inside of longing instead? Why not sell puts instead of being long the stock? You can. But usually if it's in a channel, implied volatility drops considerably, such that the yield you get on the capital employed by selling the puts might be lower than the dividend itself. FCX ends about 50. Will you sell June 50 puts on FCX with the same amount of share that's called away? Probably not. Probably not. I think copper has run too much, to be honest with you. This morning, I was looking at copper. It was up 22 cents. The front month was up 22 cents a pound. I'm looking at the front month now. It's down 3 cents a pound, down at 4.92. It was up at 5.25, over $5, 5.20, 5.21 per pound. I thought, this is ridiculous. There is nothing about the world inventory right now that justifies a price over $5. Over $4, sure, but over $5, that's a big deal. It just seemed to be overdone, and sure enough, that disappeared very quickly. But still, 4.92. I think copper is susceptible to a significant correction, and that would correct FCX. How do you take out your money for spending purposes? I don't need to. What are your protocols as a full-time investor? Well, I don't need to. I don't need to take it out, so no, I don't. Last week, Pfizer hired a veteran pharma analyst from Citi to run its corporate strategy and lead its capital allocation committee. Any thoughts on an analyst going into an advanced operational role like this? No thoughts really. I mean, saying he's an analyst or the person's an analyst is, I'd have to see the resume. I'd have to see more than that. If for some unforeseen reason the BOC does not lower rates, how would it impact your high conviction retrade? It would not. It might just extend my holding period, but it wouldn't change my conviction. 10-year rates have a direct impact on the 30-year FRM. Any reason why you observe the spread between the two? Haven't you just answered your own question? The US 10-year rates have a direct impact on the 30-year FRM. Any reason why you observe the spread? Aren't you answering your own question? I don't know how to answer that other than yeah. I'll say yes. Yes, you're right. That's all I can say. Didn't your beta short trade lose immediately? Well, I mean, when you enter a trade, and if you're not in green immediately, do you close it? Do you give up that? Do you always give up that early? And the short beta trade was, if you listened, was so that I could have a long extension. So it serves two purposes. But I mean, to just take a trade, and if it doesn't immediately turn green, say, okay, I'm wrong, I'm out. Well, that's day trading. I mean, you're going to be wrong a lot if that's what you're doing. What is your hedging strategy? Long extension. You close out the trade at a loss or add to it. You tell me you give me a scenario and I'll tell you what I'll do. What am I going to do in the next hour? I don't know. You tell me what will happen in the next hour, I'll tell you what I'll do. I don't know. And even if you tell me what happens in the next hour, the second question is, well, why did that happen? Because why something happened is just as important as what happened. So I won't know until it actually happens. But I don't see myself closing it out this early. I mean, it's not like I've been at this for a year and it's time to give up. I don't know that I would close it out this early at all. No. Why did you buy, Mark, did you buy any copper stocks? Which one? Freeport. I've been saying that for a long time. When it was down in the 30s, if you had the applied level portfolio construction, I showed you how to do an allocation factory on FCX when it was under 40 bucks, when it was sitting around 36 to 38 bucks, maybe even 35 bucks. I showed you how to do an allocation factory. And that we were trying to get an allocation of, let's say, 600 shares. This is how we would do it. Freeport. Given that rates must come down, is there much downside to buying TLT January 26 calls? Well, you're going out a year and a half. Keep in mind when you buy calls, right? Let's say the price of TLT is here, and you're going out a year and a half. Well, it's going to be higher by the interest rate. So even if TLT starts going up and interest rates start going down, the price of the call will start dropping. So if you paid $15 for this call and you're going up, Delta makes it 17, but the drop in interest rates brings it back down to 15, that even though it's going up, you might not be making anything because the interest rate and time at the same time could be taking away your gains. So you're buying a lot of interest rate built into that call. A lot of the interest rate built into that call. Someone explain what 4.5B at 602 is about. I don't know. You added some shares of ABR. I'm just curious, why didn't you sell some deep in the money puts? Just wanted to buy it. I don't know, just wanted to buy it. What's happening with ABR? I was away and didn't pay attention, not gonna lie. A short squeeze. Kindly, what do you mean by short defense? Something like ABR short defense. Well, there was a short report, and I defended ABR from that short report. That's why it's called a short defense. If you know why QQQ outperforms SPY regularly over a long time. Well, QQQ is primarily technology. I think it's 40% weighting on technology. So technology tends to outperform over long periods of time. It tends to outperform. So that would be why. And that's it.